I'm almost ready. Okay, here we go. Okay, good morning, everybody. It's Tuesday, February 17th, and it's 11 a.m. And I've got Max here. Where is Max? Don't see him. Oh, you know what it is? I've got something on my screen here. There's Max. Max, I'm kind of annoyed at Max. I've kind of made him world famous, and it's hard to keep him here. And I have to give him treats here to let me just give him a treat here, just so. There you are, Max. Yeah, but that's if you stay, all right? I think Max got tired of these videos. I hope you're not tired of them, but Max is with a little help from Treats has decided to stay here for a while. We'll see how long he stays. Well, it's cold here in New York, and I'm a little tired of it. My wife's a little tired of it, and so we're going to go to St. Martin on Thursday and come back on Monday. We take these short little hops when we get too cold. So we're going to take a few days down there. So we won't do a video on Monday. We'll do a video on Tuesday, as we're doing today, because yesterday was President's Day, and I hope you all went furniture shopping or car shopping or whatever that you needed that might be discounted. Well, there's a few things discounted in the stock market these days. Software, anyone? We're clearly seeing software has been cut back in price pretty sharply. Market's been kind of indiscriminate about it. Yeah, speaking of indiscriminate discounting, some of the trucking related stocks got whacked last week because some dinky little penny stock company, uh, I don't know if they issued a press release or some news came out that they had some AI kind of sort of software that allowed them to be more efficient in logistics of trucking. So the trucking related stocks got whacked. And then some real estate related stocks got whacked on the notion that, well, if AI really works, we're not going to have as many office workers. So that's bad for real estate. And then some of these real estate companies, some of what they do could be replaced with AI kind of agents. So everybody's obviously very edgy here about the AI trade. It's become kind of the AI immunity trade. Everybody's kind of been running for the hills here, trying to figure out what is least likely to be disrupted negatively by AI. For a while there, all the excitement was all about how AI is going to increase profitability and profits. And that's kind of been our story, is that we've been arguing for a while that the AI trade, which was very concentrated in the Magnificent Seven and a smattering of other looks like Max wants to go. Okay, leave us, if Max, if you have to. Oh, no, he's hasn't decided. He likes AI. He likes the discussions about AI because AI will not replace Max. Though I know these days, who knows? But so we've got this AI nervousness. Clearly, you see it. Let's look at a couple of charts here that might be of some interest here. Let's see if I can find this one here. Yeah, okay, here we go. Let's go for this one. Okay, let me know if that's not clear, but let's see. Okay, that's something here. Let me just check on echo in the audio, Ed. Oh, I don't know why. Let me know if anybody else is hearing an echo in the audio, and let me know if you're seeing this chart here. This chart is let me change glasses. This chart shows the, can you see the chart? Let me know. Um, Anybody? Okay. Chart view, yes. Thank you. No echo and chart good. Okay. Now I'm back. This chart shows you there's various ways to show this. This is the Magnificent Seven stocks forward price to sales ratio, and you can see what it's done over the years. Here was Chat GPT was introduced. It was released on November 30th, and the price to sales ratio for the Magnificent Seven really took off. Then DeepSeek was released, and that caused a dive in the Magnificent Seven. Not so much, well, I guess back then the question was if DeepSeek could put together this LLM that was competitive with what the U.S. Magnificent Seven were working on, and they could do it rather with less sophisticated chips than the top of the line NVIDIA chips, then why wouldn't DeepSeek kind of bury the U.S. effort? Well, meanwhile, during the first and second quarters of last year, the Magnificent Seven companies reported that they were in fact going to continue to spend and spend even more. And so everybody figured, okay, so that means you have to spend money. And they're in a position to do that. They got lots of cash flow. And so the stocks had a tremendous rebound. And then Michael Berry came along and uh, with his warnings. And on December 7th, we kind of joined the crowd by suggesting maybe it's time to underweight the Magnificent Seven because they were in fact spending an enormous amount of money on AI infrastructure without really any certainty about what the payoff would be, and all sorts of other uncertainties related to the future of AI's impact on the Magnificent Seven as well as the overall economy. Let's go to some other charts here, then we'll come back to the story of how the AI immunity trade is impacting things. First, I think it's important to, as this market's kind of going through all this agita, I think it's important to keep in mind that the underlying earnings story for the U.S. is still very strong, and it's looking pretty good overseas. And so, on December 7th, not only did we say underweight the Magnificent Seven, but we also said maybe it's time to go global instead of just staying home. And I wish they'd done that about a year earlier, but it's better late than never. And I think that diversifying overseas will work. Here's the back at home here. We see that analysts certainly haven't gotten the AI, jitters. They're still looking for the earnings outlook to be very strong. A lot of that is technology companies. Maybe the software companies remain sort of in un, in as known unknowns in terms of what AI will do. AI obviously will benefit some of these software companies, but AI could also harm some of them. And over the past, since the beginning of the year, the software company stocks, investors that have been focusing on what the negative consequences of AI and forgot about how the software companies might actually be using AI to increase the power of their products. But at any rate, so you can see this is pretty encouraging. 2027. Why are we focusing on 2027 and not 2026? Well, we are focusing on both. But as the year progresses, forward earnings, which is what we think the stock market discounts when you do PE times E, forward earnings will converge towards 2027. Now, just because it's going up now doesn't mean that they can't change their minds and take it down. You can see like what happened back here in 2025, a little dip here in 2026 earnings expectations, but now we're kind of flattening out here. But forward earnings is a time-weighted average of the current year and the next year. So the next year is going to get more of a weight. So that looks good. If you look at the numbers here, the 2025 estimate, because we're still working on getting the fourth quarter finished, is $273. So that's actually a little better than we thought. We thought it was going to be like $270, but it's close enough. For 2026, the analysts are looking at 314 and change. We're looking for 310, so they're more getting more optimistic than we are. And we're thinking of actually raising our numbers given the likelihood that the economy is going to get a lot of stimulus from fiscal and monetary policies this year. And then next year, so this year, they're already up to 363, and we're using $350 a share. So there's certainly room for some disappointments and still get the kind of earnings outlook that we're anticipating will get us up to 7,700 by the end of this year. So, and I guess the numbers of 350 times 22 should get us to 7,700. This is, I've started to expand our portfolio of charts I want to share with you on a regular basis. This is the S&P 400. Obviously, there's more interest now in the Smidcaps, and you can see that the Smidcap, the mid cap earnings, the 400, have actually gone down. Same thing here for the current year. So we have seen that the forward earnings obviously will converge to a higher number. So that's the good news. But it's not quite as upbeat a picture as seeing this thing going up for the S&P 500. This is the small caps, the 600. We prefer that to the Russell 2000. Most companies in the 600 actually have earnings. The 2000, I think something like 40% of the companies in the Russell 2000 do not have earnings. So I kind of like earnings. And you can see that the 2027 estimate for the small caps is holding up reasonably well, as they are for 2026. And you can see that this little spike here. So things are getting a little bit better, but they're still below their all-time record high. This is another way to slice and dice the same numbers. Take the squiggles out and just look at the forward earnings levels. And this is actually in dollars per share, and you can see where we are with the S&P 500. And by the way, this is one of my favorite economic indicators. It's not too good at predicting recessions, but since it's available weekly, on a weekly basis, you can kind of in a recession see how bad things are getting. Here's kind of a smooth path down. Here's a quickie. And then we had this huge recovery, a little dip here back in 2022 when the stock market decided to have a bear market, even though we didn't have a recession. And then it's been a very strong recovery ever since, giving credibility to the idea that the economy is resilient and strong. Lagging behind have been the mid cap, the mid caps and the small caps, but this is somewhat encouraging. It's very odd that ever since 2022 until recently, they've kind of flattened out while the S&P has gone higher. But again, this is starting to look better. And the stocks obviously have reflected that. This is the S&P. Let's see, this is the same thing on a ratio scale. One account raised the issue that doesn't like it when you don't show things on a ratio scale because they tend to exaggerate, and that's somewhat true here. This is more on a ratio scale, but it's pretty much the same story. So here's the Magnificent Seven. Their earnings, forward earnings, have been very strong. We've seen the S&P 500, that's the red line, has been strong. And take out the Magnificent Seven, it's been okay. It's been for a while there, it looked like it wasn't going anywhere, but it's been climbing. And again, we can put it on a. This is actually not on a ratio scale. I'll have to get David to put that on a ratio scale. But again, you can see that this is taking out the Magnificent Seven just for scaling purposes, and you can see that the 493 have been doing really quite well. Growth versus value, you can see that growth continues to be very strong for forward earnings. Values kind of picked up. You still have growth earnings outperforming value earnings. I guess that's the nature of the beast. But on the other hand, the valuation multiples have reflected that. This is the Russell 2000 versus the Russell 2000 for the S&P 600. And again, we prefer this, but we watch them both. And you can see that even though there are a lot more losers or companies that don't have profits in the Russell 2000, they've both had the same configurations for overall forward earnings. Then we started introducing in this kind of package of earnings, a more global perspective. And you can see that the all country world is doing quite well. The forward earnings all-time record high. So analysts are raising their numbers. What does this look like for all country world ex-US? Actually, it looks pretty. It looks pretty good here. Look, this is kind of going nowhere fast. I mean, this was higher than 27 was higher than 26, but we've since late last year we've really taken off on earnings expectations for 27 and for 26, and so forward earnings has really taken off, and obviously the stock market anticipated that last year. This is just the U.S., so it's the same thing as we've seen before. And David, if you're listening, we got to just clean that up. So this is developed world ex-US, just developed world. So Japan's in there, for example. Where forward earnings have been very strong. And this is fascinating, right? This is emerging markets. Emerging markets really have emerged here in terms of expectations for 2007 and 2006. Keep in mind that emerging markets, they're not all the same. We've got Taiwan and South Korea in here, and basically we've got Samsung and Taiwan Semi in here, and that's had a big impact there. But even so, other emerging markets, commodity-related emerging markets, for example, Chile has done well because of copper, South Africa because of gold. Poland has its own story. William wrote about it this morning. China, on the other hand, has been a real laggard here. I mean, 27 is above 26, but the estimates haven't been very exciting. So let's now switch back to the U.S. and look at the S&P 1500 sectors. And it's really fascinating how just like somebody flipped a switch and everybody rotated. It's like, okay, I don't know if it's musical chairs or just a switch, but everybody at the same time decided to rotate out of the Magnificent Seven, out of the tech and communications, out of this consumer discretion, out of financials, and to everything else. You can really see this kind of mob. It was kind of like, what do they call them? Flash parties, where you kind of post, hey, let's all go dancing in the streets on this particular street. I guess it can also be used for flash mobs. So let's all go protest for one thing or another. But here's the S&P 500, 600, 400, 600 stock indexes. The blue is the S&P 500. It's stalled out below 7,000. We know that the market is rotated by looking at the S&P equal weighted 500, and that's at an all-time record high. And again, I think we We did okay. Actually, we did pretty good. Calling in early December for getting out of the or underweighting the Magnificent Seven and going to market weight in tech and communication services. Benefit of hindsight, it probably should have at least been on a short-term basis an underweight. But anyways, the market has broadened out. You can see that the mid caps have continued to do well. I think industrials in this have been particularly strong. And then the small caps have also gone on to new record highs. Now, here's communication services. Got to an all-time record high on the S&P 500, backed off a little bit. I guess some of that was Google offsetting Meta's weakness. Not much to get excited about with the SMID caps. Look at consumer discretionary. Again, they seem to be having a problem getting to kind of a new high here on the 500. Maybe some of the volatility and Tesla's holding it back. And the same has been true for the SMID caps. Consumer staples, on the other hand, here's where everybody kind of got, the switch was flipped, and so everybody suddenly ran here. Now, of course, somewhere along the way here, I think early on, Walmart decided to be a NASDAQ stock, and so Walmart's kind of become I think in some ways it's a magnet that should be the Magnificent Eight because it's if Amazon is a Magnificent Seven, why shouldn't Walmart be in there? But it's become more techy for sure. But the other SMID caps haven't really done much. I mean, they've had a nice rally, but we're not talking about record highs. Then again, look at this energy, bang, goes straight up, kind of across the board. I was thinking about recommending overweighting energy, but on the other hand, I think there's lots of oil out there. But I think what's happened here is with the tensions between the U.S. and Iran, possibly leading to a military confrontation, that's pushed oil prices up. And with the rotation, people say, "Well, what's really cheap that hasn't been picked on?" And energy was, and because of all this climate change stuff, the energy companies have underspent in infrastructure and capital. It's almost like the exact opposite of the AI story. The AI story is too much capital spending, and the energy is not enough. And so suddenly everybody jumps in energy. There could be an opportunity if things get negotiated with Iran. I mean, I find it hard to believe that Trump is really gonna get stuck with a war in the Middle East in front of the midterms. Um, and I think he'd prefer to have energy prices stay low. So we'll see how that plays out. Then again, he may go for one of these one day attacks that get everybody's attention and then declare victory and pull the military or the Navy further away. Financials have been disappointing to me. I guess it's a mixed story now with AI having both being a blessing and a curse for some of these stocks. They've also had a big move here, but on the other hand, the still like the regional banks, and they're kind of included here in the 600 and the 400. Uh, Healthcare has been a disappointment. But it's kind of hanging in there. Biotech stopped going straight up, but healthcare we still think is a good place to rotate into. Industrials we've liked all along and reiterated that we think it's a good place to rotate into, and that's done extremely well. And again, it had one of these kind of uh, switch on moves into rotating even into more industrials. The IT has been obviously a laggard here, an underperformer. The look at this, the 400 is doing quite well, as is the 600. The materials, like the switch got turned on and everybody rotated. Now, it's pretty easy to overweight materials and energy since they account for what, something like 3 to 4% of the market cap of the S&P 500. So it didn't take much money to move these areas. We obviously started out liking gold a lot, but it's become more than just gold. It's base metals, it's chemicals. They've all done very well. And real estate, not a story that I know particularly well, but again, it looks like the switch went on here. I guess the market's back to thinking that the Fed's going to be cutting interest rates after the employment number came out, maybe not, and then after the CPI number came out, maybe so. And then of course the utilities. We're doing quite well all along here with the AI trade, but now maybe they're an interest rate trade. Maybe they're still, they're still an AI trade. I mean, if the AI negative is spending too much on infrastructure, well, then that means we're going to get more energy spending. So that covers kind of what I wanted to talk about. Let's see if I can unshare here and have a move around my Q&A so I can have a better look at it. Um, okay, so far I got lots of people telling me the charts are good and the audio was clear for most of you. Why don't I have one question from Cactus? Um, if anybody else wants to join in, please do. Hi Ed, hope all's good. How much does the recent speed of AI agent development worry you about narrative changes on one, AI being a margin killer versus margin booster for the stock market with many moats taken out? Good point. Two, AI becoming a substitution factor for labor market instead of complementary factor, increasing exponential unemployment rate, increased risk for the economy. Cactus, two good points. Been thinking about all these issues. I think we all have been. And I think it's going to turn out that there's going to be winners and losers. The problem the market's having is trying to figure out who that's going to be. So in terms of the Magnificent Seven, the hyperscalers that are spending all this money, is it going to be Google? Is it going to be Microsoft? Is it going to be Oracle? All these companies, they're spending an enormous amount. Um, Amazon, these are companies that have done very well over the years. They're very well managed. They're very well plugged in. Um, I don't think they'd be spending all this money if they didn't have the perception right now that they need a lot more capacity because the demand is just rising significantly. I don't know about you, but I'm using AI all the time now, and I use it as a research assistant, and I think it's become better and better. I trust it more, but I trust and I verify, and sometimes I'll check one against the other. Sometimes I'll go to the hard data sources just to make sure I got it right. If that the AI got it right, but the more we use it, the more there's a demand for capacity, obviously, and that it will pay off. And then, we're looking at AI related technologies that are also likely to be booming. As Elon Musk pointed out, robotics is a huge deal. Autonomous driving is kind of taken a while to happen, but at some point, we're not going to have to own cars. We're just going to be able to, on our app, order driverless cars. We can do that with Uber now, obviously, but what's the point of owning a car and having it sitting in a parking lot or in the garage 80% of the time or 90% of the time? So that the whole world will change. But I would say that it's a known unknown. This is why the market's got all this volatility in it. Is no one knows for sure who will get a big boost for their margins and who won't. I would think that Musk has been talking about automated plants with robots run with AI, kind of 24 by 7. And how do you measure productivity in that world? I mean, if you got one person just checking that everything's going okay on an iPad somewhere around the world on a factory, is all the output attributable to one person? I mean, the concept of productivity becomes kind of confusing in a world where things are uh, things are made, and maybe even services are delivered increasingly autonomously. Um, but I think what we're seeing here is sort of investors are going for what the known knowns, and I think what the known knowns are more in the physical world than in the virtual world. So they got very nervous, obviously, about software and other kind of business models and services that could be uh, where the margins could be killed, as you said. On the other hand, energy is energy, healthcare is healthcare. I mean, I think healthcare stands out to me as an area where there's tremendous room for productivity, as we all know from our experiences with the healthcare system. And you know, I mean, Musk is talking about robots doing surgery, but I think that's going to be a long ways off. Um, then Cagnes, he asked AI becoming a substitution factor. In terms of, yeah, I mean, some of the people like Bill Gates and others have been talking about a universal basic income for a while here. That at some point, what are we going to do when we have all these everything's automated? And I guess we're all going to need some sort of basic universal income to so we can consume the goods and services produced by this automated economy. And so that's something down the road, but we'll have plenty of time to talk about that. Um Frederick, do you think the recent decline in gold is about selling what you can at a profit? I think there's some of that. I think there's more of that probably in Bitcoin. And I don't really think gold is sold off. I think it's just kind of consolidating around $5,000 an ounce. And I still think gold will be fine. I think, the physical world commodities will be fine. AI, the one certainty about AI is, these companies are going to spend a tremendous amount of money on building data centers. Let's not forget that one day one of these companies, one of these hyperscalers may say, you know what, we're going to cut back our spending for a while here. It could be because they can't find plumbers and electricians. It could be because, well, I mean, the real plunge scenario, at least for a 1 day plunge, would be if a hyperscaler says, you know what, we overestimated demand, we're going to cut back our spending, and instead of spending 150 billion this year, we're going to spend 100 billion, and that's 100 billion still real money, but relative to perceptions that things have changed. So it creates a lot of uncertainty about what's the next surprise going to be. But I think the global economy is doing very well, and I think finding cheaper places to play around the world. And I don't, I'm no expert on individual emerging markets. I was listening on CNBC this morning. One fellow, I kind of tuned in on my radio on Sirius, and one fellow was saying Brazil could be a great short or a great long, depending how the election goes for Lulu. If Lulu gets elected, then there'll be a big short. If his opposition wins, then it would be a big long. I prefer just to go with the ETF. You could do EEM, which includes China, and China's about 50% of it, but I don't like investing in China for reasons we've discussed before. So you could go with the EMXC, which has actually outperformed the EEM, which includes China. Um, let's see. So no, I would stay with gold as a. I think it's a great diversifier. I've shown you a chart before showing the inverse relationship between gold and the S&P 500, and they're inversely correlated on a short-term cyclical basis. Long-term, they have the same trend. So if we get to 10,000 on the S&P 500 by the end of the decade, I think we'll get to 10,000 gold by the end of the decade. Will you be sending out the charts from today's webcast, found China earnings versus other EM? Uh, if you if you go look on the website at the very end of the chart website, there's something called the In 10 Plus Charts, and you'll see the forward earnings chart book in there. I'll take a couple more, though I'm overstaying my welcome here. Diane, are you hesitant to raise S&P EPS estimates due to accelerated depreciation expense this year? Yeah, I'm still trying to sort out how that plays out. I don't. I think that's more a tax issue and a cash flow issue than it is a profit issue. But I'm talking to people who are more understand these accounting things. Melissa Tagger works for us, is looking into it. David, hi. David Einhorn was on CNBC last week saying the Fed will cut rates a whole bunch of times versus the two cuts the market is pricing in. He thinks Warsh will come in and lower rates, creating arguments to persuade people to see things his way. Do you agree with this take? No, not at this point. I'm not saying he's wrong, but that's not my base case. My base case is they do nothing, but the bond market doesn't agree with me the past few days here. We should have some really good inflation news up ahead here, and we've documented that. But the economy is strong, and so there's no particular reason for the Fed to lower rates. If it does it, then we'll get a melt up in gold and commodities and in the stock market, and then we'll have to figure out when to take some profits. I'll take just two more. Lee, while the SCOTUS ruling on tariffs has been on the back burner, it's supposed to. One fellow I follow says it could be February 20th, but that would be right before the president's State of the Union, and they may not want to do that. While the SCOTUS ruling on tariffs has been on the back burner, what impact would the ruling have on the Fed's rate policy if tariffs are deemed to be illegal and reversed? I think the Fed would just kind of wait to see how it sorts out. But with the benefit of hindsight, tariffs didn't have that big an impact on inflation, other than durable goods inflation, which is moderated. It's really had more of an impact, obviously, on bringing in about 250 to $300 billion in customs duties that might have to be returned. So I don't think it's going to be. I don't think anything special is going to change in that regard. Sal, last question. Ed, if you have not tried Tesla's full self-driving, you should. The latest software update is really good. At some point, it'll be required because it's more safer than human drivers. I had an accident last June. The car was totaled. It was a four-bagger. Four bags went off. I had a little bit of, I shouldn't comment on my ailments to see what my lawyer wants to do about it. But I'm basically okay. I'm still functioning. Few ailments. Anyways, I bought I didn't look at the Tesla because I didn't really want to get into the recharging hassle. But I think once my lease is up on this Camry, I'll probably do the Tesla because I really like that screen where it gives you a real view of who's all around you, and I find that very comforting. Well, I hope I've said some things that are comforting to you, but all in all, the first half of the year so far is working out kind of the way I thought with rebalancing, kind of the way I thought with volatility, though the causes of volatility were not what I thought. I hadn't anticipated the AI immunity trade, but it may continue to be a little volatile here in the first half of the year, and then let's see how the second half evolves. Maybe that'll be also volatile given the midterm issue. Anyways, thank you for joining me. We'll do this again next week, Tuesday, when I come back from vacation with a suntan or a sunburn. Thank you.